yeah, so basically I'm busy building this, and it's going to be available this time, yeah, not this time next year, this year sometime. But basically there's a whole bunch of knowledge inside of here that I'm creating. So there's like reading lists of things that would be important to read, videos that get created by myself, or ICT videos get created, important notes that we would learn about ICT. Like if you forget what a kill zone is, you'd come in here, or any particular notes about a particular month, for example, because there's 12 months of learning for ICT. So everything is pretty much organized and categorized over here. And then this is my database that I'm building. So this is what you guys will have access to. It's been a while to create this, but basically we would come in here to this database, and let's say in the future you wanted to find out more information about a rejection block, for example, or any particular subject. You'd come in here, open basically this information, and there is notes, and eventually I'm going to upload videos as well into here. But that's what this database is for. So obviously now it's sort of useless to you because you don't understand most of this stuff. But yeah, internal range, liquidity. So this is what I'm building, and it's like a searchable database of sort of anything that you would need relating to ICT. But anyway, that's, yeah, we can always discuss that later. So without further ado, I'm now going to continue with what I was going to continue with. And the first thing on the list over here is going to be this, which is trading on leverage, basically. So some of you probably know what leverage is, and it's a very beginner basic understanding, and I'm not going to do a lot of basic teachings, but one of the very basic things we must understand when we are traders, because we are retail traders, we are trading on leverage. And you've probably heard the terms leverage 1:100, 1:50, 1:500, 1:1000, and often brokers, whichever broker you are with, will incentivize traders to sign up with that broker because they offer high leverage, and that is attractive to traders, a general populace, a large group of traders, is because it allows people with small money accounts, small capitals, $50, $100, $500, $1,000, to make large trades and make large amounts of money, whereas it obviously can be a lot of risk assumed with that leverage. But I'm just going to quickly explain to you what leverage is. Just quickly, let's just get a feel in the room here. Wandile, can you just explain to me your understanding of leverage quickly?
Yes, hope you can hear me. Well, I think leverage is like, it's sort of like a loan that your broker gives you so that you are able to open positions that are worth more than the initial deposit you put in your account.
Okay, Roger, do you have anything to add to that understanding of what your interpretation of leverage could be?
No, I think he summed it up great. I actually got a insight for me in the way he explained it. So nothing to add there, Darren.
Yeah, okay, so Wandile is pretty much correct, about 90%. Think of the leverage like when you buy a house or buy maybe a car, you need a down payment or a deposit, and that is the money that is required to open a trade. We call that the leverage used, which is actually the margin. So I'm going to show you something over here quickly. It's going to take a few moments. So for example, this is a demo account I've opened specifically for this. And this demo account over here is $1,000 trading account with a 1:100 leverage over here. And what we will do is we will just open round number of 0, 10, and do whatever. And we will sell this over here. So when we sell this, okay, just like Wandile said, it is a down payment over here. So we can see there that based on this trade, we've opened a 0.10 lot size and the margin is 100 over here. Now that means that that money is not lost, the $100. It just means that it is held by the broker. So what leverage does, it allows us to take trades based on potentially more money than we have. So the smaller the leverage you have, the less amount of trades that you can open. And the reason for that is because the margin, this little number over here, the margin requirement will be higher for a lower leverage. So this is a 1:100 leverage. And if I go to my same account here, which is just basically $1,000, but with 500 leverage, 1:500, what we will see is something rather different over here. So let's see, Alex, what do you notice that when I open this trade over here on USD CAD for a sell on both accounts, 1:100 and 1:500, what did you notice? Alex, you there?
Yes, I'm here. I really can't see your screen because it's very small here.
Okay, that's not a problem. I don't want to give the answer away just yet, but the answer will be pretty easy. Is there anyone who would like to answer the question for Alex because he can't see the screen?
I'll go for it, Darren. Yeah, I could see that the margin changed to 20. You know, the previous one was 100 based on the 1:1, and with this one, the margin changed.
Yeah, so what we see there is that the margin is only $20 for this 0.10 lot size. Does anyone know why the margin is 20 and not 100? Emmanuel, maybe you know?
Yeah, I think that's because of the leverage. In the first instance, it was 1:100, and in this case, it's 1:500. Therefore, the margin is 20 for that reason.
Okay, and why is it 20 and not 100? What is the leverage on my account for this trade that we opened first was 1:100, and this account is 1:500. So what do you notice? Manuel? Okay, we lost you. Doesn't matter. So what you all should notice is that this leverage is 1:100, and if I log back into this account over here quickly, we will see that the margin requirement is 100. Okay, so on this 1:100 count, we opened a 0.10 lot size, and the margin requirement is 100. The free margin is the available amount of money in the account that can be used to open trades. Now, you cannot keep opening trades until this goes to zero, because as the old phrase goes, you'll be margin called. There will be a margin call, and the broker will close some of your positions out. So that is what margin call is. When there is no more available free margin in the account, and this number goes to zero, you will then suffer from margin call over here. So what we see, the margin is 100 on the 1:100, and because this 1:100 is 5 times smaller than, well, the other account, we can see that that 100 becomes 20 over here when we sign into it. Why? 2, 4, 6, 8, 10. The margin is 5 times greater on the 1:500. So that means the margin is 5 times less. More leverage, lower margin requirements for each trade. So effectively what this means is that for the risk takers out there, they can open large positions on their account. And let's see here. So if we open a 1-lot trade, that is a $200 margin on which account? The 500 leverage, 1:500. But let's see what happens over here if we go to 1:100. Can we do it? Probably not. We cannot do that. Do you guys notice that I cannot sell over here on USD CAD because 1:100, the margin requirement was 200, and if my requirement is 200 on the 500 leverage, that means that on a 5 times less leverage, my margin requirement would be $1,000. However, what we could do is halve the position, and the margin requirement for this would probably be about $500. And there it is right there, $500 over there. These margins are money you get back once the trade is closed out by a stop loss or margin call, or it hits take profit, or you manually close out the trade. That is the margin, so you get that money back. Now, trading on a lower leverage account is better. However, when you have a small account, $50, $100, $500, it is good and advisable to trade with low leverage. However, it's not feasible for most people because they can't even open a 0.5 trade or a 0.2 trade. So that is why brokers incentivize traders to trade with higher leverage. All it means is that you can effectively open a larger lot size on the account with a smaller capital or smaller balance. That's effectively all that margin really is. Okay, so having said that, hopefully you all understand now the difference between higher leverage and lower leverage. Lower leverage is more margin, higher leverage is less margin. Does everyone understand? Is there any questions from this point? Does anyone have any questions about margin?
Yes, Alexia.
Mm.
Regarding those broker offering higher leverage, does it mean that it's more risky and they wipe out our account faster?
Yes, there is the potential for that, because if you think about it, on this account over here, which is our 1:500 account, and we open this, remember we opened a 1-lot size of trade over here, which means that for every pip that moves, it is how much? $10 a pip. So really, price would have to only move for our margin call to occur about 79 pips. So if I put a stop loss over here, and I just remove this out the way, make this a little bit bigger here, you will see that we will blow our account, sort of, will not blow it, but we will be margin called roughly about here for the margin call over here, which will basically stop us out or go into margin call. So that is effectively, and then you'd be left with only a couple of $100. So yes, you can trade with more money or more lot size, but at the same time, obviously with a higher lot size comes higher risk. Okay, but that doesn't mean that you're going to just blow your account, because what is likely to take place is that you should be, I didn't want to really go into this, but I feel like I need to, and this would be a risk calculator over here. So does anyone understand or not, does anyone not understand position sizing? Or would anyone like me to elaborate on position sizing? Alex, you asked the question, so do you understand position sizing?
I first time come across this website. Maybe it's good to go through for the benefits of those that don't know.
Okay, well, I'm going to touch on this lightly. We can always touch on it again later if I get feedback that people understand it slightly or don't understand it at all. I'm not going to spend a lot of time on it because this is really basic stuff. So we should all understand this, but I'm just going to touch on it lightly. So obviously, our amount of lots we can use on a specific trade is decided by how much we want to risk of the account with our stop loss. So if we wanted to risk, let's say 20 pips and we want to risk 2% of the account, we will use a 0.10 lot size over here. But if we reduce our stop loss to say 10, then that becomes, instead of a 0.1 lot size, that will become 0.20 because we are reducing our stop loss. So we are risking the same amount of money while reducing the stop loss. So therefore the lot size will increase. However, there is, like I mentioned with the leverage, you'll get to a point where if your risk is too high, for example, let's say you were risking 3% and you had a very small stop loss of 5 pips, you may get to a point where your lot size is greater than the amount of leverage available to you. So let's say, hypothetically speaking, that this account we had over here, that was the 1:100, we were not allowed to open a trade of 1 lots because we did not have enough free margin available. But if this leverage was not 1:100, but rather 1:50, we would not even be allowed to open a 0.50 lot size over here, even if we had $1,000, because the leverage would not allow it. So we wouldn't be able to open this 0.60 lot size with a 5 pip stop loss and a 3% risk. We wouldn't be allowed to do that because our leverage does not allow that. Okay, so that's why people say with the more amount of money you have, generally trading on a lower leverage is the way to go. And anyway, the benefits of higher leverage can be used, but it really depends on your trading style, because obviously if you're just opening 1 or 2 trades, then it isn't going to affect you as much. But the more trades you open, the more leverage you have, or is required rather. So if we close this trade over here quickly, if we open a bunch of, let's say, 0.10 trades, each trade will have a margin requirement. So here it's $20, but if we open another cell, well, it's 40. So open another cell, it's 60. So as we open more trades, the margin goes higher because each trade has its own margin. So that you can go into margin call, and it is possible, but there's a fine line between how many trades you actually need to open, how many setups you find, and how much leverage is required. So I'm not going to go into much more detail about this. I just wanted to give everyone a basic understanding of what leverage is, because it's a very misinterpreted or misunderstood element of trading. Most people don't even really know what it actually means. They think that you're just going to make more money because you've got more leverage. And while that could potentially be true, it can also blow your account because you don't understand the responsibility you need to have with higher leverage and the amount of risk that you're going to use. Okay, so position sizing, margin requirements go hand in hand together. A good understanding of that will allow you to have a healthy account. Okay. So hopefully there's no further questions, but basically that is it for trading on leverage over there. I'm going to move on, and we can touch on leverage another time if there's more questions, but I don't want to spend too much time on it because, you know, there's a lot of time to be spent elsewhere, and we can always just have questions later. Okay, so Emmanuel without the double M, Emmanuel Mainga, can you for me tell me what you see on the screen right now?
Good morning. Good morning, class. Yes. What I see on the screen right now is risk reward and win rate.
Okay, and tell me what this means to you. What is your understanding of what you just see on your screen right now?
For me, on other words, the risk reward is depend on how much you put in the trade, and where your stop loss at and where you take profit at. So let's say I want to trade GU, and then I place a trade. My stop loss it's at let's say 15 pips,
Yes.
and my take profit is at let's say 100 pips.
Okay.
So that's let's say I'm not just calculating. It's about maybe 1 to 10 or 1 to 50 risk reward ratio.
It's an easy calculation. Do you know how to calculate it quickly, Emmanuel? Do you know the calculation?
Not well.
Okay,
but,
so it's simple, right? All you do is,
Okay.
let's say, like you said, you've got 100 potential pips of take profit. Let's say it hits the take profit and your stop loss
Yes.
was 15. All you need to do is you took 100 pips, so you had 100 pips, and you divide your stop
By
loss
15.
into that, and then you press
Oh,
enter.
by 15.
Yeah,
Okay.
because that's your stop loss size. So you divide, you take your total take profit that you won versus your stop
Yes.
loss, and you divide your take profit by your stop loss, and then that is your risk reward ratio. That is a simple calculation. So that is a 1 to 6.6.
6.6.
Roger,
Got
do you understand what we're talking about here? Roger, your mic is muted if you are there. Okay, Roger is not there. Wandile, are you here?
Yes, I'm here.
Okay, so do you understand what we just spoke about in terms of risk reward over
Yes,
here?
yes, I understand. Yes.
Okay, and then your interpretation of risk reward, do you understand it well enough to apply it to your own trades?
Yes, I do. I think it's like the sort of like percentage gain you can make from a trade based on how much you risk for that trade.
Yeah, it's either percentage gain. So if you risked 1 and you made 3%, that is a 1:3. Or if you risked 1 pip and you made 3 pips, 1:3. So whether you calculate it in terms of percentage gain or pip gain, it's really the same thing. Obviously, pips would just be more than the percentage because percentage is less than pips. But pips, actually, a lot of people don't even know what pips stands for, which is PIPS, which is percentage in points. That's what pips stands for. So effectively, pips is the same as percentage. And most people don't know that. Just a little tip for you guys if you didn't know that. But do you understand now, Wandile, how to calculate quickly what your potential risk reward for any trade that you would take using a calculator over here?
Yes.
Okay. So would you agree with me, Wandile, then, is that if we are taking trades that is, say, 1:1, 1:2, those would be much easier to take and win than if we were to try and take trades of maybe 1:3, 1:4, or 1:5. Would you agree with me?
Yes, I agree. But I also think that if you take like those low risk to rewards, you would need like quite a lot of them. Say like maybe if you making like 1:2s, and let's say your target is to make like I don't know 10% per month, you would need a lot of those 1:2 trades.
In terms of being profitable over a series of trades, though, say 5, 10, 20 trades, at the end of, let's say, the 20 trades, you would have to win more trades with a smaller risk reward. Does that make sense? Like you just said. So,
Yes.
you'd have to take more trades and win them with at least what's shown here. If we were saying taking a 1:2, we would have to win 40% of the trades over 20 trades. So 40% of 20 trades we'd have to win for us to be profitable. according to this, if we took 30% accuracy as wins on the 20 trades we took, we would not be profitable. So let's see here, who has not spoken? Roger, are you there? Okay, Roger not there. Alex,
Yes.
would you say as a starting trader who's, say, new to the trading scene, let's say they've only had like 1 year or 2 years experience, would you say, or would you agree or disagree, that catching trades of 1-to-1, 1-to-2 is easier than catching trades of 1-to-3, 1-to-4, 1-to-5?
It's easier.
So to catch 1 is to
I
1
think
or 1 is to 2, or is that easier to catch trades like that, or is it easier to catch trades of higher risk reward, 1-to-3 plus?
I think 1-to-1 is, or 2:1 is a lot easier because normally good ratio won't come easily.
Yeah, so you'd be correct in saying that, okay? For the average trader to come in and start trading with any strategy or whatever they're going to be doing, it's a lot easier for them to take profits when price has moved with them in their favor for 1-to-1 or 1-to-2. But if we find that whatever strategy we are using to apply or take or find trades, that most of the trades we are taking, if we are not for 1-to-1, 50% or higher, we will not actually be making money. We'll actually only potentially be breaking even or just barely profitable. So we'd actually be having a higher accuracy requirement because of our low risk reward. And the reason for that is the following. Many of you possibly know, I see Temitope has joined. Sorry if I butchered your name there. Sorry, we're just getting into the risk reward here. You haven't missed too much yet. We were just explaining margin requirements, but it's fine. You can always watch the recording. So what we're essentially saying is that with a lower risk reward, your accuracy is required to be higher, whereas with higher risk reward of 1-to-3 plus, your win rate or accuracy can be lower because your reward is greater than your risk by much more. Okay, so it allows for less accurate trades. And again, the reason why this is the case is because everyone has probably heard this, is that, before I say it, Roger, are you here? You're not here. Temitope, are you here? Can you unmute your mic?
Yep, I'm here.
Okay, perfect. So can you answer for me the following, and that would be what you have heard in the marketplace or from other people, or what you've read. What do they say about the amount of risk you must take? What do they say?
The most common thing I've heard is that 2-to-1 is like the minimum. If it's below that, then it's not a good trade in speech marks.
Okay, and in terms of how much we must risk, what is the rule? Or what you've heard?
I've heard 1% of your account size on each trade.
Okay, so yeah, general rule of thumb is that we don't risk 1 or 2% or greater than that if we're starting out. Okay, so, and then what have you heard regards to every trade you take? Do you take the same amount of risk or more risk?
So I've heard that it depends on like the amount of confluence you have. So if you're more confident in the trade, you may risk more, and if you're less, you may risk less.
Okay, so
I'm not sure if that makes sense.
Yeah, that makes sense for what I've heard also. And the general consensus among the public is that for most people, when you are trading, you want to risk the same amount of money. You don't want to, risk 1% and then on your next trade you risk 10% or 5%. You want to keep the risk the same. That's what general people believe in the marketplace. So as traders, we come here as risk mitigation experts. That's what we are essentially doing. We are trying to minimize the amount of losses we can take. Yeah, sure, it's great to win, but at the same time, when we lose, that can have a negative effect on our psychology and our emotion. And because it has a negative effect on our psychology and emotion, it can influence our decision making logical side of the brain, that thought process that we go through. So we see it through the losses we've just made, and let's say we've lost 3 trades in a row. We now try to win back the amount of money we lost, and sometimes people do this and they potentially risk more. So let's say they lost 3 trades in a row with 1% each. Maybe they'll keep the same amount of risk, 1%. So if they lose the 4th trade, they're down 4%. Or on that 4th trade, they try and risk 2% to make back, the amount of money that they've potentially lost. And I'm going to show you risk mitigation. Okay, it's great to win, but it's also good to be a good loser, not a sore loser. So I'm going to show you something over here. And we classify this as static risk and variable risk over here. So static risk is taking the same amount of risk on every single trade over here for 5 trades. So that's whether that's 1%, whether that's 2%, whether it's 1.5%. Static risk means that you're taking the same amount of money on every single trade. And that's the general rule. Like you said, Temitope, that based on the trade idea or what the trade setup looks like, you can change the risk. But the general rule of thumb is that most people believe you should risk the same amount of money or risk on every single trade. Whether they do that or not, that's a whole nother ball game, because most people don't have that consistency. But the general rule is that static risk is the way to go, and you should risk the same amount of money on every single trade, regardless of the outcome of every trade. So if you take 2 losers in a row, you on your 3rd trade, you're still risking the same amount of money. If you win 4 trades in a row, you're still risking the same amount of money. So I'm going to call this variable risk, because that's basically what it is. And essentially what it means is that based on the outcome of individual trades, we will either increase our risk or hold the same risk or decrease our risk. So as we go over here, if we take 5 trades with static risk, we are risking the same amount of money, whereas with variable risk, we decide on 3 risk variables, which would be level 1 risk, lowest level of risk, and that can be 0.5, could be 1%, 0.2%, whatever level 1 would represent to you, or however much money you like to risk, and that would be your lowest level of risk. Then we have level 2 and level 3 respectively. So each level, whether the outcome of the trade is a loss or a win being we increase the next trade's risk, losing will basically pull us back down. Okay, so if we look over here, we do the same amount of trades, 5 trades, and over here, this is a 0.5. Same trades, same losses, same win streak, same lose streak over here. At the end, if we look at static versus variable, a 1-to-1 would have lost us, based on the outcomes over here, at 1-to-1, we would have lost 2%. Whereas on variable risk, we would have potentially lost 1%. So as a starting trader, like we said, lower risk rewards is easier to come by than the higher risk rewards. The higher risk rewards would come later. And I see this meeting is about to end, okay, which means, okay, is there any questions so far about what I'm explaining here about this risk management system? Yes, Alex,
Yes.
go ahead.
Yes. Regarding calculation of risk and reward, has it to be so manual? Because I have seen on TradingView, the risk reward ratio calculation is a lot easier by just clicking on the screen, and then it will show on the screen and calculate it for you. Or is there something similar on MT4?
So there's no tool that MT4 allows over here. So if I go to MT4 over here, there's no tool that allows you to apply what TradingView has, and that's just the unfortunate part of TradingView versus MetaTrader, and that's regardless of MetaTrader 4 or MetaTrader 5. There's no tool for that. However, a lot of people do use a Fibonacci tool on MetaTrader as sort of like a hack to determine take profit entry levels and where your risk reward would be, say 1:1, 1:2, 1:3, etc. So there is a workaround for that using the Fibonacci tool, but as the raw MT4, MT5 is, there's no tool like that. However, if you are proficient with MetaTrader, so I've used MetaTrader for many years and I still continue to use MetaTrader old school, I already know how much I should risk, how much I should put as my lot size based on how much pips I'm using as a stop loss size. So obviously my stop loss size determines how much risk potentially I will take on the trade based on the lot size. So you can't do it on MetaTrader, and the tool that you're using on TradingView is correct. You know, you can just apply it and it easily gives you your risk reward. I don't think it gives you your lot size, so you'd still have to use a calculator of some sort. I think there's even apps you can download from the App Store on your iPhone or from the Play Store on Google. That is risk reward apps. Basically, you can just use that to determine how much your lot size should be. Does that answer your question?
Okay, actually, I've come across some EA on the website that is free to download. You just have to apply 3 clicks, then you'll be so-called calculated and displayed on your right top screen.
Yes.
So if that one, anyone interested, maybe I can show you the link.
You're correct. So there is alternative ways to get around MetaTrader or MetaTrader 5 using expert advisor, but again, that's then applying additional expert advisors and things onto the chart, and that possibly would be an indicator available also for TradingView and also for MetaTrader. So there is that workaround, and if you do want to share the link, you can always just share it, Alex, inside of the Telegram group if you want to do that. But regarding this though specifically, do you have any questions?
Okay, I carried it out. No, you are all very well explained. Thank you very much.
Okay, so I was going to continue explaining this over here, and what we were saying before the call ended was that if we took 5 trades based on the same outcome, so we can see here that this trade is based out of 5 trades, and let's say of the 5 trades, our first 3 trades are losses and the last 2 trades are winners. So first 3 trades we take, and this is a possible outcome of, you know, taking trades in a live market. You don't know which trade is going to win. You could have so many confirmations, so many confluences, so many reasons why you're taking the trade, and it can still hit your stop loss, knock you out, or go against what you thought was the case. So it is very likely that it can be a possible scenario that you could lose 3 trades in a row. And if you were risking 2% or 1% on your account, and if you lost 3 trades in a row, it is very psychologically and emotionally damaging to us as the trader, going and suffering 3 losses, not to mention we would be down at the end of 3 trades 6% if we were risking 2% each trade, or 3% if we were risking 1%. And then trade 4 and trade 5, we've made 2%, okay, but we still didn't make back, so it'd still be a net negative of -2% over here. And this is only 5 trades. Now imagine 5 trades, then 10 trades, 15, 20 trades we're taking. We don't know which of the trades of those 20 we're going to win or we're going to lose. We don't know that. So the purpose of the variable risk scenario management is to assume that we want to mitigate risk. So the purpose here is that we start at the lowest level of risk. So in terms of the static risk over here, every trade is the same, whether it be 1%, 2% of the account, whereas variable means that based on the outcome of the trade we take, we risk level 1. If we lose level 1 risk, well, our level of risk doesn't change because we're at the lowest level of risk. We lose trade 2, well, we're still at the lowest level of risk. We lose trade 3, still at the lowest level of risk, nothing changes. But however, when we get to trade 4 over here, same as trade 4 in the static risk, we win trade 4 over here. What then changes is that we no longer take trade 5 at level 1 risk. We go up higher into level 2 risk over here. And trade 5, you can see trade 4 and 5, we win on static risk. So you're risking less on the variable risk, but at the same time, you're losing less. So you may potentially, in some scenarios, make less money, but you're losing less money, which is more important psychologically and emotionally speaking, because most of the time we are human beings and we are emotional creatures, and therefore we react according to what our emotions are. And most of us are not robotics, so we have feeling and emotion towards what we are seeing and how we are feeling towards the outcomes of the trades. And to lose 1.5% of our account is much better than losing 6% of our account, or 3% if we were risking 1%. It's better to lose less in any situation. We don't want to lose a lot of money. So that's where the variable risk here helps us over here. And then basically what the variable risk biggest difference is that after 5 trades, the variable risk scenario tells us to reset back to our risk, because we don't know which trades are going to win and which trades are going to lose. However, we are anticipating that at some point we will lose a trade, because it's inevitable. We cannot win 100% of our trades. Okay, and starting off, it's unlikely we're going to get 80-90% of our trades to win. It's unlikely, unless we really gotten into our strategy and we know exactly what we're doing. And there's a lot of factors at play, but generally speaking, we cannot have a high accuracy starting off. So starting off, we would use variable risk. And as the trades develop, as the strategy plays out over a series of trades, we will increase our risk based on the outcome of each individual trade. We will take a maximum of 5 trades, and on the 6th trade, we will reset back to our lowest level of risk over here. So trade 6 would not be level 3, it would be level 1, because it is the 5th trade, or the 6th trade rather. We took the 5th trade, we won it. The 6th trade will reset us back to level 1. And that is the difference between static and variable. Static means that regardless of the outcome of trade 4 and 5 being winners, when we get to trade 6, we are still risking 2%, regardless of we lost 6%, we're still down 2%, we still risk 2%. So I'm going to show you something. This is only 5 trades that we took over here. And you can see some of the risk reward outcomes. So on a 1-to-1 over here, we would be negative 2% if we were risking 2%. On a variable risk, we'd only be down 1%. If we were taking a risk reward of 1:2, based on only these 2 trades that we won, and of the 3 that we lost, we would be up 2%, but on the variable risk, we'd be sort of break even over here. 1-3, we would have made more money and we would have made less money. But the purpose here, okay, starting off, I'm not trying to say to everyone is that you're going to catch 1:3, 1:4, 1:5. That will come later once your strategy has been developed, what you know, what you need to look for. Then you can refine down, tighten your stop losses, and get bigger risk rewards. But starting out, our goal is to try and take trades that would be between 1:1 and 1:3. From there, once we know what we're doing, well, then we can, the sky's the limit. Then we can aim for 1:5, 1:10, 1:20. But that doesn't come until you understand price action. Okay, so this is only 5 trades, and we can see the outcomes over here. And effectively, what it tells us is correct. So if we go back over here and we look at this risk reward and win rate over here, it says that between 1:1 and 1:2, if we are having an accuracy of 20, 30, we are not profitable. We'll be losing money. over here for 1:1 and 1:2. And I just showed you only 5 trades, but you know, we don't trade only 5 trades. Maybe we take 5 trades a day, 5 trades a week, but in essence, it's over a series of trades that provide us better statistics of what we can expect or anticipate from the market. We can't base a strategy or get feedback from, are we making money, are we losing money, from just 5 trades. We need 20, 40, 100 trades to get back feedback if our strategy is working or something like that. So I'm going to show you the same thing, but based on 20 trades now. So there's more losses, there's more wins, there's more different scenarios that come into play over here with static risk. This is something very important, guys. So we're going to spend a little bit more time than the other sections in terms of margin. Okay, so, and this is something applicable to all traders, because at the end of the day, we're all risking money to make money. So at the end of the day, we want to risk the same amount of money and make more money, but lose less money. The goal here is to lose less money. That is the purpose of what I'm showing us here. Losing less money can help us to make more money because we are not psychologically or emotionally sabotaged by the destruction of a losing trade. So that is the purpose here. So if we take this over here and we look at what it says, this is risk management, variable risk, and levels on 20 trades. So I just showed you 5 trades. This is based out of 20 trades. And of the 20 trades, our first 3 trades are losses, and trades 4 and 5 are winners. Trades 4 and 5 are winners. So basically, it's the same as the 5 trades, but we are now just continuing on from trade 6 all the way to trade 20. So from trades 6 to 9, we lose all 4 trades, and on trade 10, we win. Now again, this could play out. We don't know that our strategy we're going to go live with when we do finally start trading, whether we trade live or demo, we don't know which trades are going to win and which trades are going to lose. I don't know when I'm trading which trades I'm going to win and which trades I'm going to lose. That's why there's risk. And that's why we have to play with this risk variable so that we can make the most of our winners and make the least of our losses. We don't want to be losing lots of money because it is psychologically damaging. So we can see here that trade 6, 7, 8, and 9 lose. And we could do that. We could lose 4 more trades in a row, because when you lose a trade and you lose your next trade, it's very likely that you could lose the 3rd and the 4th trade. Why? Because the previous trade may influence your decision-making process of the next trade, even though the next trade has technically got nothing to do with the previous trade. So the previous trade you just took should not have any effect or the outcome of the next trade, but because we are human, it does have an effect. Emotionally and psychology have an effect, not the outcome of our strategy. It's got nothing to do with the strategy here. It's about the emotion and psychological aspect. So looking at this, trade 11 is a loss from trade 12 to 15. These are all winners. 11. So basically, we've lost from trade 6 all the way to trade 9. Trade 10 is a win. Then trade 11 is a loss. So we just won, and now we lost. And then from trades 12 all the way through 15, we go on a winning streak here. We get 4 trades over here that win in a row. And that can happen also, which is a euphoric state. You know, we'll feel great about ourselves and unstoppable if we now win 4 trades in a row. So as bad as it is to lose 4 trades in a row, it is equally as bad to get into a euphoric sense of invincibility that we've just won 4 trades. So we don't want to be in that state of mind. We want to be complacent and have a static frame of mind where we're not influenced by the outcome of a loss or the outcome of a win. We are just the status quo, flatlined. So here, all the way through, we've just won 4 in a row, and now we go on to trade 16, and now we start to lose. We lose 5 trades in a row because now we've just won 4 and we think that, oh, well, you know, I know what the market's doing, and then I'm going to take a trade, I'm going to lose. And I'm like, oh, okay, well, you know, it's just this trade. And then you take your next trade and you lose it. You take your next trade and you lose it. And then you sort of go into that destructive state of mind. And then you lose 5 trades in a row. And it's a very likely outcome. It's very possible. It's not unlikely that this can happen. So if we look at this total, we've taken 20 trades here. Of the trades, all of the 20, we've only won 7. And we've lost 13. So our accuracy is only 35% over here. Now, if we're trading on a 1:1 or a 1:2, we're not going to make money here, right? Does everyone agree with me?
Yes.
Okay, so everyone is in agreement that on a 1:1 or a 1:2 potentially, we will not make money. Let's double check ourselves. So it says here that on a 1:1,
Yes, I agree.
1:2, yeah, thanks, Manuel. So 1:1, 1:2, with a between 30 and 40% accuracy rate of winning trades, we will not be profitable. And the reason for that is because we've risked the same amount of money on every single trade. But the difference now comes from static to variable. So if we take the same trade outcomes, every trade that was a loser versus every trade that is a loser on the variable risk, it's the same outcome. So every trade we lost in succession is the same here. But the only difference is that we are using variable risk management over here. So if we look, trades all the same. Lose 3 trades, win 1. Trade 5, we win. What happens on variable risk at trade 6? We reset our risk. And we are taking risk at the smallest level of risk until we get a winner. Until we get a winner, then only do we move up to level 2 over here. So you can see here, we lose 3 in a row, we win trade 4. So trade 4 means because we won trade 4, we move to level 2 on trade 5. But because we've taken 5 trades now, we reset back to the lowest level of risk, which would be risk level 1, whatever that value would be for you, whatever you want to be. So this is a build your own sort of risk management system here. So level 1 for you could be 1%, level 2 could be 1.5%, and level 3 could be 2%. It's really up to each individual here in this lesson to decide what each level 1, 2, and 3 would represent for them, because everyone's got a different risk appetite. But the outcomes are going to be the same, is that we are losing less money, and that is the goal here. So when we get some losing streaks, we are losing far less money than we would when we have losing streaks in the static risk over here. So when we go on this losing streaks, we lose less money. And if we go on a potential winning streak, so over here, from trade 12 over here, we win those 4 trades in a row, trade 12, 13, 14, and 15. We are increasing our risk. Do we see that? So trade 12 we win, which means trade 13 will be level 2, which would be the next level of risk, which would be 1%. And because we won 2 trades in a row, we're now on level 2. Trade 14 is at level 3 risk. Trade 15, well, there's no higher level than level 3, and we're on our max risk, so we take trade 15 at this level 3 risk. But now, because we've taken the next 5 trades, what does our variable risk tell us? We need to reset to anticipate us losing in the market. That is really what separates the variable risk from the static risk. So there we go on that losing streak. And we don't know if we're going to lose 4 in a row. We don't know if we're going to lose 3 in a row. We could lose 2 in a row. We could just lose 1 in a row. But again, I'm saying worst outcome scenario. And I'm doing worst outcome scenario because that is the eventuality of trading, is that you could blow your account. But if you have the right risk management properties like this, it's very difficult to. Okay, so over here, in trade 16 compared to static, we are already now on the lowest level of risk because our risk reset tells us to go back to level 1 after the 5th trade. So after trade 5, we reset. After trade 10, we reset. And after trade 15, we reset because it's a series of 5 trades. So all of these are losers. Well, that doesn't matter because we're at our lowest level of risk. So static risk, if we lost 1, 2, 3, 4, 5 trades, that's 10% of our account we just lost to. Whereas over here, 5, 10, 15, 20, 25. So 2.5% was only loss compared to 10% loss. Same outcomes. 20 trades taken, 7 winning trades, 13 losing trades. So remember, what did the risk reward tell us based on a 1:1 or a 1:2? We're not going to be profitable, right? But we are
Yeah, we're still not profitable.
Yeah, but look at this, guys. We are profitable. Barely, but we're still profitable. Based on a 1:1 and a 1:2. The same trade, the same 20 trades, the same losers, the same winners, based on variable versus static. Do we see here that 1:1 and 1:2, and even 1:3 here, that we actually were able to at least break even and a little bit more? Even with a 35% accuracy. So what does 1:1 tell us, or 1:2? It tells us that we're not going to be profitable, but that is based on static risk. Every trade, the same amount of risk. It's not based on variable risk. That is the key element for today's takeaway, is that variable risk starting out allows us to lose less money. Starting out, when we're traders, we want to lose less money. Sure, it would be nice to make a lot of money, but at the same time, because we're starting out, we don't want to have this negativity of losing trades to not make us want to trade anymore, because that's what happens to 90% of people, is that they win a couple of trades and then they lose a whole string of trades, and then they say, oh no, trading is not for me. But they don't understand simple stuff like this. That's why I'm spending more time here at the start, because this sets the foundation for whatever we're going to do, whether we trade trend lines, moving averages, price action, Wyckoff, ICT, BTMM, or whatever the next great thing is, Holy Grail. Okay, that it's got nothing to do with strategy. We're looking at what influences our decisions based on risk. So the outcome of today's teaching, sole outcome, would be, if you take nothing away from what I've taught you today, at least take away that variable risk is a better way to start trading than static risk based on a leveled risk system. That is the key takeaway here, guys. And I want you, as homework, as your project over the weekend and into the next lesson, is to design yourself, whether it be on a piece of paper, you type it out in Excel, or if you are going to use Notion like I'm using Notion, I can share you this template, and you can put in your own values and take your own trades on your demo. Maybe you've got a strategy already and you're trying to attend these classrooms to improve on your own strategy or your understanding of what I have to teach. At the end of the day, it doesn't matter whether you're trading what I do using ICT, BTM, Wyckoff, retail stuff. We can apply this risk system to any type of trading. And that is what's so important, is that we want to lose less money. Sure, looking at the statistics here, that static risk with a higher risk reward value will make us more money. But it's not always about making more money. It's about being, or having the psychological or emotional capacity to suffer loss. That's what separates the average Joe trader from people who actually want to trade consistently for long term and stay in the markets, not just be a quick 90-day trader and then gone back to your day job. Our goal, or everyone's goal here, hopefully, is to, in the long term, transition out of a day job and be consistent traders. And how we get there is by applying a proper methodology to how we take trades based on risk. So we make less money here using the variable risk versus the static risk, but we are losing less. That's what's really important. And you can change this later. Obviously, once you get better at trading and you know what to look for, you know your strategy, and you're just basically looking every single day for your strategy, doing the same thing, nothing's changed, you can use static risk. But starting out 1 to 2 years, you should be using variable risk model of trading until you can exceed 1:3R on your trades, because then it doesn't matter based on the accuracy. So obviously, if we think about what the accuracy is here, it's 35% on these 20 trades. In 20 trades from 6 months time, and you take the same 20 trades, you might have a better accuracy. Instead of getting 35% winners, you might get 50%, which then also influences the outcomes of return versus loss on those trades. Is there any questions? Because this is very important, guys. Thivakaran, are you here? Not yet?
Hey Darren, don't know what my sound is like.
No, it sounds good.
Oh, it's working. Oh, okay, no questions or anything, Darren. I mean, this was, I think this is one of the things for me that I've, taken for granted, but it can really support your longevity in the markets. And I've kind of overlooked this, I mean, in the sense of, you stick to a static risk, but there's a price for that. And so variable risk is always better, I think, for me also. I see myself as a beginning trader. So thanks, Darren. I'm actually going to rewatch the video, and I would actually like this template as well. To build a little system for me and try to building the system. I don't think is that difficult. It's sticking to that system that I found challenging. Thanks, Darren.
Okay, sure, no problem, Roger. That's perfect. So yeah, definitely rewatch the video, guys, because it may not come around to you the first time I'm explaining it, but the more you watch it, the better you will understand it. And if you understand it from the get-go, well, then thumbs up to you. Some people do, some people don't. It is a little bit complex, maybe if it's the first time you are seeing something like this, but you can see based on a very low accuracy rate that and I did this specifically on a a low accuracy rate, because I wanted to show everyone that by using variable risk, we can potentially lose less money. And that's really the goal of the variable risk, is to lose less money, not make more money, but lose less money. And that's always very positive for our psychology and emotion and the way we feel towards taking our trades. Alex, I see you watching quite attentively. Do you understand everything that's going on?
Yes, first time come across this, because all this while I've been taught to just use static risk reward ratio and didn't know that the outcome of, in fact, not aware of such thing as a variable risk reward ratio.
But it's an eye opener, isn't it?
Yes. I probably have to go through a few more times to have this sink into my mind. Very well done. Good.
Okay, so at the end of the day, guys, the key takeaway here would be to gain the ability to take trades based on a variable risk scenario starting off. If you're taking trades that are not higher than 1:3, you should be using variable risk. If you decide that you are now elevated as a trader, you know what you're doing, then by all means use a static risk. And obviously you can still sort of have a mixed system where it's a bit of a variable and bit of a static. If you know that you know what you're doing but do suffer some losses, you can always just pull back on your risk. And if your risk rewards are quite good, well, then there's a sort of a dynamic approach to static and variable. It's a blend of the two. But definitely starting out, as I know most of us are, we should all be using variable risk. I myself have a sort of a blend of the two. Like if I do take maybe 2 trades that are losses, I would maybe just reduce my risk a bit, but I do know what I'm doing and I have a strategy that I look for every single day that doesn't change. So if I don't see that specific setup, then I don't take a trade. So for me, I'm really just stuck on the static risk part of things. Is there anyone here that was using variable risk? Okay, I don't think there was, because some of you possibly knew about it but weren't using it. Is there anyone who has not learned this, that is new to this? Like, for example, Wandile, I see maybe you wanted to say something, you unmuted your mic.
Yes, myself, it's the first time I hear variable risk, and what I just want to ask is that since you recommend that, like for people who are like relatively new, they first start off with 1-to-1 and 1-to-2 risk to rewards, right? So, what about like? So, are we saying that a trade, like in terms of if you take a trade and you, when you're looking for your targets, you should base it on your risk to reward instead of like certain levels in the market. Like for example, let's say you see a setup and let's say your stop loss is about 10 pips and your next take profit level according to what you're seeing on the chart is like 50 pips away, and that gives you like a 1-to-5 risk to reward. Should you base it on that? Like, should you base your targets based on a risk to reward or based on certain levels in the market and what you're seeing on the chart?
Okay, that's actually a very good question, Wandile. So the answer to that question is sort of a mixed answer, whereas later on we're not really discussing strategy or exit or entry or targets of a trade, but that is a very important question because later on you will learn how to apply this sort of risk reward trading scenario versus the variable risk to an actual trade where like you just said, that maybe you should enter a trade based solely on the purpose of trying to catch 1:2 or 1:5 or whatever, where that's not actually the case, but there could be a filtering criteria where, for example, you find yourself a setup and your goal for every trade to catch is at least 1:2, and if you do not believe that price can get for, wherever you want to sell or buy to get to 1:2, then you should not take that trade. So I would say at a bare minimum, most of us should, if we are taking demo trades or doing whatever we're doing, we shouldn't be targeting 1:1. We should be targeting at a minimum 1:2, or even at a worst case 1:1, 1:1.5, like sort of in between the two. Definitely 1:1 is, it's shouldn't really be our goal at all. So we should start at 1:2 and then sort of move on from there when we're ready. But the outcomes for your risk reward should not determine where we place our target. So like we can't say to the market, we have to have 1:5. So I'm putting my take profit there and I'm holding. I don't care what happens. I'm holding for that 1:5. You'll learn more about the market and what best practices to use, because obviously the market doesn't just give you 1:5 or whatever you think you want. You really have to just pay yourself as the market makes money available to you. So sometimes, I like to target, if I don't think price can move at a minimum 1 to 3, then I won't even consider the trading opportunity. That's my own personal trading strategy is that if I don't believe price can move at a minimum 1:3, then I'm not even going to bother entering the trade. Obviously, I'd like to target higher, 1:5 or whatever plus, but if I don't think it even can move 1:3, then I'm not going to take the trade. So one dealer, you'll learn about, where to take profits, maybe scale out some profit, things like that. And then this, regardless of, if you're targeting a 1:2, 1:5, at least you'll have some sort of sense of where you should be exiting some portions of the trade, taking some profits. But that will all come later when we start to look at the actual concept. So right now we're sort of laying the key foundational phase of what we need to do as traders, and that is risk mitigation. Good. So it seems to me everyone's understanding the part where I was explaining margin, and now everyone seems to be understanding the part where I'm explaining the difference between a static versus a variable risk system. So hopefully everyone does get it, and if there is any questions, you can always email me on that thread we created, or ask in the chat of the Telegram group. Or we can just have maybe some questions at the beginning of the next lesson for like 5 or 10 minutes. If there is any questions, you can always think about it. Or if there's anyone who's watching this who isn't in this live meeting, who's watching the recording, you can always send me a mail, ask in the chat, or at the next lesson. We'll set aside some time. So I just wanted to see how far we are here. So I've planned out what we should cover over here. And my goal was to cover the leverage, which we've covered. We talked about risk, maximizing the risk with less risk taken, risk rewards. And over here, this would be sort of our journaling process. So that's a very important element. So I see that the time is going to run out again. Okay, so just quickly before I move on here to our next phase, there is actually a document that you guys will have access to if you wanted access to it. And this is this Excel or Google sheet that I've created. And basically you could come in here and basically input some sort of value of what your potential outcome could be for a year. And I'm just going to quickly show you this. But over here is our money as our initial deposit, and we'll have a goal of how many pips we want to catch on a weekly basis over here. And based on that outcome of that weekly pips of how many we want to catch, based on how much risk we want to take on each trade, will tell us how much lot size we are using and what is the value of that pip per the lot size. So hopefully we all know that each lot size we take represents a monetary value attached to that lot size. And obviously based, like we said, with risk reward, the amount of lot size you used is based on the amount of risk you take versus the stop loss size. So obviously if you have smaller stop losses, you can use a larger lot size while risking the same amount of money. So it's just hypothetical scenario over here, that if we put $1,000 in our account, and why is it doing that? Over here, we have $1,000 in our account, and our goal is to catch 50 pips a week with a 0.5% risk and a 20 pip stop loss, which is, quite doable. We will grow our account by every week, which is 4 weeks a month, by $40, which would be inevitably 4%. Now, obviously, it could be more, it could be less, but realistically speaking, it might be only less. But this is very conservative because it's only 20 pips and it's only a 0.5% risk on each trade you are taking. It's very likely that you could make 4%. Now, 4% doesn't sound like a lot of money, and most of us would probably want to make a lot more than just 4% on our account, but that's not always possible. So realistically speaking, this is a very conservative approach, and you can all have access to this. It is in this sheet that I have over here for this template, and you can all get access to it, so you can come and play with it over here. But basically you input your values and then you are outputted with what your potential gains for that account size would be. So by the end of the 12 months, so to speak, when we reach December. So if we've traded from January all the way through to say November or December, we've realistically grown our account to 153 of positive profits over here. Now that's obviously wins, losses included, so it's sort of a net gain of roughly 7%, 7.6, 7.3, and obviously that amount would potentially grow based on the compounding of the account. So again, this is compounding your profits with your capital size. Now, obviously that may not be applicable for you because you have to withdraw your profits to pay for bills, or later on when you're trading, if you're making money, you have to pay your bills, so you need to withdraw. So you can't always just, you know, deposit more or, you know, compound 100%. So realistically speaking, it may not be applicable to you, but then you can just change the compounding value. So if you're going to keep your account compounding at say 80% or 50% or 100%, then these values and everything will change. I'm not going to spend too much time on this. You can go and play with it. If you do have questions, you can always email me or ask me in Telegram or the group, or email me, so you can go and play with that. Okay, so what I wanted to finish off with was journaling. Okay, so many of us probably have heard the term we should journal our trades, but many of us probably don't, or refuse to, or think it's a lot of work, or, you know, just downright don't do it. And the lack of not journaling is probably the lack of your consistency and why you are attending this class. So again, we said that the variable risk is quite important, and so too is journaling. Okay, so can anyone tell me why they think journaling would be important? Start off with you, Emmanuel, with 2 M's. Why do you think journaling is important?
Yes, hi everyone again. For me, journaling is important. Why? Because it's more about to be sure from where you were at the market and where the market will be. So in the end of the day, is for you to know the difference if the market it's really reached where you want it to be, or it's to that level where you expect it or not. More likely, I don't know if I'm correct.
Okay, no, you're on the right track. Thanks for your answer. Roger, are you still here? Okay, Roger does not hear.
I'm here.
Oh, you're here. Roger, do you journal your trades, your demo trades, your whatever trades?
I'm good. I'm gonna be honest, Darren. I actually don't, and I mean, I know, like you said, I don't know if it's a mental block. I don't know what it is, but yeah, I've not been doing it. Oh, apologies. Lots of messages coming through. Yeah, so I'm not doing it. I do make short little snippets of notes, but I don't think I'm giving journaling justice that I should give it. You know. So yeah.
Okay. And of the trades that you take, Roger, let's say over a course of a week or over a course of a month, how many trades do you think you've been able to take or identify?
I've only been doing demo. I've jumped off the live trading. I've felt the
No,
pain
that's
there.
fine.
So I've been off live trading for a while. I
That's
mean,
fine.
if I look at some of the trades, sometimes there's only 1 or like 3 trades that I see in the whole week that I can take.
Okay. So
So
roughly
yeah.
speaking, maybe over a course of a month, you find at max maybe 10 trades or 8 trades.
Yeah. Yeah.
Okay,
Yeah.
that's perfect.
Yeah.
There's nothing
I've
wrong
also
with
got a day job as well, so I'm juggling between that. But you kind of right there, Darren. So that's kind of the number I'll go with.
Okay, so it's much more easier to journal less trades than it is to journal many trades. So the goal of us as traders should be to journal every single trade that we find. As much time as we spend on the charts looking for potential trade setups, and none of us should actually be tracking any setups now because we don't know how to trade, and we should be journaling these setups. Whether we take the setups, whether we don't take the setups, we should be journaling. So if we take 4 trades a month, 4 trades a week, 4 trades 2 months, 4 trades in a quarter, all 4 trades must be journaled. Whether we take all the trades or whether we just identify the trades, we should journal every single trade, the before and the after. Now, again, it's a tedious task. It's probably not very fun, as much as fun as looking at a chart would be. So it's much more fun to look at a chart than it would be to journal your trades. But think of it in retrospect, that if you were trading for a company or a prop firm or for somebody who's given you a large amount of money and they questioned you on every single trade that you took, and you gave them an answer of, it looked good, market should go down, I think it's going to sell, I believe it's going to drop, silly things like that. If you can answer them with just one-liners like that, then you obviously have no faith in yourself. So the purpose of that would be to refine down and improve what we journal. So again, let's just start off here. What can be used to journal? So there's many different ways to journal. Okay, when I started, I journaled using an actual book where I used to write things in, and I never actually printed pages, but a lot of people I know do print pages and write on the pages and then file those pages inside like a flip file kind of thing. And a lot of people do write into a notebook. Okay, now every way that you journal, there's pros and cons attached to the way that you journal. Okay, I personally have transitioned from a physical copy to a digital version of journaling. And the reason for that is I like digital. I'm a person who comes from an IT background, so I prefer to do things digitally. And writing in a book was great, but it takes a lot of time to write. Whereas copying, pasting, quickly typing something out, drawing boxes, drawing price action, taking a screenshot is much easier than having an actual physical hard copy. So I transitioned away from using a notebook of written text into Telegram. I used to use Telegram as my journaling, and only in the last, I'd say, 9 months have I transitioned into what I use now, which is Notion. And I can without a doubt say that when I've transitioned from my notebook to Telegram and now to Notion, it has substantially elevated my thought process, my learning sort of curve, my identification, my problem seeking of things that I was doing wrong. It's elevated my trades in many aspects. And I would employ some of you to try and do the same. Is that if you are using something that is written, try and transition digitally, whether that you would want to or not, that's entirely up to you. I'm not forcing you to, but it has its pros and cons. And I've listed some of the things here that some people use to journal electronically or digitally, what they use to trade. Now, the reason I use Notion is because it's sort of an everything in one app. So think of Word, think of Excel, think of OneNote, Trello, Evernote. So all of these apps, Telegram, it's basically every app in one app, and that is why I use it. It's very flexible and versatile, and there's many ways you can use this information. So like, for example, over here, I have an area where I document price action observations, so sort of like educational price action that maybe I didn't see recently or haven't seen for a long time, or maybe a trade that I found that I learned from, things like that. I document into my journal, which is part of my whole entire system. So I have many little pages over here. So I've got like risk management, I've got my trading ASR, which is advanced self-review. So I review all the trades that I take over the course of like a month or the course of a quarter, and I document everything. I take screenshots of everything, and I document the whole shebang. I don't leave anything out. So as much trades as I take is as much as I document. And whether I take the trade, whether I don't take the trade, live, demo, actually I don't have a demo account, but if I don't take the trade, I still journal it. If I take the trade, if I win it, if I lose it, I still journal it. So basically what I'm saying, decide what you're going to journal or use to journal, stick with it, and maybe you can improve it later, but you have to journal. If you're not going to want to trade long term and you want consistency, you have to journal. Okay, so that's just, you know, the rule of trading. If you're not journaling, you're not trading right, and because you're not journaling, you're probably finding inconsistency and you're not profitable. So you need to journal. The purpose of a journal is to help you improve identification of your setup. Now, if you don't have a strategy or a setup that you look for, well, it's going to help you through your learning process, because not only is a journal used to document setups, it's used to journal everything that you are going through emotionally, psychology, all aspects of trading. It's your journal. It's how you're feeling. Did you fight with your wife? Did you fight with your girlfriend? Did someone break into your house and steal your belongings? Did you have a car accident? There's many variables in our personal lives that can influence our trading, and when we take note of those things in the journal, we can substantially improve the outcomes of, in retrospect, when we review this information. So it's repeating what you are doing and making sure that by repeating what you're doing, you're looking for the same thing once you found your strategy, and it's keeping you disciplined. And because you are disciplined in what you're doing, it basically translates into better consistency. And obviously with consistency, it's a process of basically not being profitable to being profitable. So, you know, risk reward, finding a strategy, journaling your trades, getting educated about the market has the outcome of being or giving you consistency. And consistency is not on the charts, but rather in your mind. And if you understand that consistency is not found in the chart, as our good old friend Mark Douglas always says, it's not in the charts, it's in your mind, is where the consistency lies, then it is the journal that takes us there. Okay, so what do we put in a journal? Okay, we don't put silly things in a journal like entry price, exit price, the lot size we take. We don't put that in the journal because that's already on our trading platform. You know, C Trader, MetaTrader 4, MetaTrader 5, it's already got all that. Okay, so it's pointless to go and journal those things when it's already there. Okay, so that's a waste of time to journal those things. We should basically journal everything, like I said, winning trades, losing trades, trades we found as part of a strategy, or trades we are using to learn price action, everything we find. And it's not limited to only screenshots of trading, but maybe PDF documents you want to read, websites you want to watch, or YouTube videos. All of that is part of your journaling. You need to put it in there so that constantly are using your journal to elevate your trading. So again, what if we have this journal, what do we put in it? Well, obviously there's some really essential things, elements of this journal that we need to have. And you know, you can have all of the ones I have listed here, and you can have more, but essentially at a bare minimum, when you take let's say a trade, or want to take a trade, or identify a trade on whatever you're going to trade, gold, oil, silver, copper, platinum, GU, EU, whatever you're going to trade, Bitcoin, whatever, you need to have the time frame that you're going to trade, okay, or time frames, maybe it's multiple time frames. You need to have the reason, you know, written out, why you took the trade, what was there that you saw that would make you believe it's going to buy or sell, and you'll later learn about these. Okay, so confirmations and confluences. So many people think that a confirmation and a confluence is the same thing, but it's not. It's two separate things, and you'll learn later what those are. I'll teach you. But obviously that would be your reasoning behind you taking the trade. So you'd write out a description of, you know, why you want to take the trade, and that would be a reason. And obviously it's pointless to have this journal if you're not going to use it for taking screenshots. Okay, so you need to take screenshots of, you know, what it is that you're looking at. So, you know, you can just write out time frames and X, Y, and Z time frame, 1 hour, 4 hour, daily, weekly, whatever time frame you're looking at. You can write all that information, but you can also take screenshots. Then you don't have to write it out. So that's where the pros and cons versus a written versus a digital journal supersede one another, is that with a digital journal, attaching screenshots to an area where you can journal has its benefits over a written journal, because if you had a written journal, you'd probably have to either draw the price action or print out chart that you're going to trade and then write on that piece of paper. So obviously, you know, that's definitely a con. It takes a lot of time to do all that. So that's where digital journals are much better. So also very important, as part of journaling, you want to journal what your mental or emotional state of mind is. Like I said, what are you going through? Are you fighting with your wife? Is your kids screaming in the background? Are you distracted by something that's happening in your personal life? Did you just lose your job? Did you just get a promotion? There's many variables when it comes to our trading, where we should be, what we are doing, and how our personal lives affect that trading. Okay, and like I said, you want to keep educational materials handy so that you can review those educational materials as part of your journal. So maybe books you want to read, any sort of education, whatever materials, be audiobooks, videos, whatever. And you're going to learn from yourself, basically. That's the whole goal here of the trading journal. And then if you are taking trades, you want to be asking yourself questions. This is really where maybe for someone like you, Roger, you said that you weren't journaling your trades and you weren't really finding consistency because maybe you weren't thinking to ask yourself some basic questions that when the trade was over, did this trade, for example, follow my strategy? Like you wouldn't know that unless you were journaling your trades, because then you could trade 4 trades or whatever per month, and each one of those trades you weren't actually sure if it was part of a strategy or just because it looked like it was going to sell, or just because it looked like it was going to buy, or it was on a hunch based theory. So really, once you have a strategy and you then ask yourself, regardless of the outcome, whether it's a win, a break even, or a loss of a trade, you want to ask yourself, did this trade follow my strategy? Now, these are obviously just basic questions we should ask ourselves, and you guys should formulate your own questions for your own journal when you're taking your trades. And it's very important to understand that I'm showing you this in the manner I'm showing you this because this lays the foundation for what we're going to learn in the future when we do get to the level where we can actually take live demo trades or live trades on an actual account with what money we've deposited. So it's very important for us to be ready for when that time comes, and how we get ready is by creating now, from this day, journaling. You know, that's why you don't have to take a lot of trades, because it's double the work. You know, you've got to take the trade and you've got to journal it. So that's what separates, you know, us from the average Joe trader. We are willing to journal. And if you're not willing to journal, well, then you're basically saying to yourself that you're not willing to be consistent in trading. Because I know for a fact that Michael, ICT, still journals to this day. And I know he actually uses just writing in a book. Maybe he uses something digital now, but he still to this day journals. And even, you know, big hedge fund traders, prop firm traders, they actually have their own internal software that they use to journal reasons to take trades. And they hedge fund managers actually review the journals of the traders that are trading. So it's not like it's just us retail traders are doing this. You know, big people who manage big money are also journaling. Just basic things, guys, like was there an opportunity for a better entry? So maybe you identified a trade and you took the trade based on whatever setup that you saw, and you executed the trade. But maybe like an hour later, you know, a little bit of drawdown, didn't quite hit your stop loss. But if you maybe found a better entry on a lower time frame, well, then that question could have just been answered with either a screenshot or yes, there was a better entry. Okay, this is just basic stuff, guys. You really need to take the reins here for yourself, because we're individuals, we're all adults here, and you know, you don't become a doctor overnight, you don't become a plumber or whatever simple thing, you don't learn whatever job you're going to be doing overnight. You have to get training on the job or educated of what you're going to do, and then you become, you know, that profession. Same as trading. Just because there's no university or college for trading doesn't mean that there's now no rules. It's a cowboy environment, and that's what really separates the people who make it in trading and the people who don't make it in trading. Okay, so you guys can come through all of these questions over here and you can review them yourself. You can copy these if you want to for your own journal. You can formulate your own questions. Okay, but basically the idea is that the more information that is available to you when you review your trades, the easier it will be to identify the mistakes you are making. And that is what the purpose, okay, of, creating review questions would be. Okay, that doesn't only relate to review questions. If you think of something else that should be added over here instead of just time frames, screenshots, etc., you add it to your journal. Okay, choose a journal, whatever works for you, whatever app works for you, choose it. Okay, if you want more information about what I do on Notion, I can send you guys videos of where you can learn how to use Notion. But again, that's what I use. I'm not forcing you all to use Notion. Most of this information available to you will be just on a web page, and I'll actually be able to just share it with you. I can just copy this link over here, and it's basically just a website that you can visit where you'll have access to all of this information. Okay, so that's also another reason why I use Notion. Okay, so if we understand that what we're putting in the journal and how we can use the journal, or what type of journal we can use, well, what is the purpose of having the journal? Okay, so let's just quickly go through it here. Okay, well, as being a trader, we have complete freedom. Okay, there's no boss looking over our shoulders, as most of us are probably employed. We don't like the boss to watch over our shoulders. We are free to work when we want to. Very true, very nice lifestyle. We don't have to ask for bathroom breaks. It's quite ridiculous that we have to do. If I remember, I was in a day job and I had to do that too, be excused to go to the bathroom. I mean, that's ridiculous. We can eat lunch whenever we please, breakfast included, okay, or dinner whenever we're trading, okay. We can do whatever we want basically because we are our own boss, and obviously being our own boss comes with risk, comes with responsibility. So, use it, don't use it. We have the potential to handsomely be rewarded for our risk based on the work we perform. Okay, so I'm not going to go into detail, but you guys should come and read all of this. Basically, I've just highlighted a few important items, and trading is a skill that is acquired over time. You don't just become an overnight success, or if you are, then you just got lucky the one trade and maybe you made a lot of money off just one trade. You've probably seen a lot of YouTube videos like that, and that's not realistic. Trading is a skill, just like any other skill, that is acquired through practice. Okay, so in retrospect, why we are journaling, think of it, if you don't know who Michael is basically the founder of the ICT, Inner Circle Traders, and he came up with, whatever you think you know about order flows and order blocks and voids and gaps and all of that stuff. That is Michael Huddleston. And think of it like, you were trading for Michael, or you were one of his students, and every time you took a trade, he was asking you, why did you take the trade? So if you can't answer his questions, he would laugh at you in his little cynical voice that he has and say, that's ridiculous, man, with his American accent, and say, I don't know what you're doing, and you shouldn't probably continue what you're doing because you don't know what you're doing. That's his little cynical remarks he makes. And so another few questions here, 13 or so questions. You can come and read through some of them. Again, just something to add to your journal. This is really just to help you guys develop your own journal. It's not sort of copy and paste. You can copy and paste if you so wish to, but again, it's to help you all understand that journaling is important, and you should ask yourself what it is that you are doing, and if you are doing what you are doing, why you are doing it incorrectly, or where can the inconsistencies be found. Because there's obviously, if you're not making money, you're inconsistent, and you need to identify these inconsistencies so you can be educated on how to solve those problems. Okay, so like for example here, you're going to ask yourself after the trade, here's a couple more questions. So like, what was the order flow and all the bias of, the market? Like if you were taking, say, GU and you tried to buy this week, well, you would have been in heavy drawdown. over here, because price basically just sold from the week's open all the way down over here. And that was predicted. I did predict that. Okay, so I did get a couple of trades in here, but basically if you try to buy this, there may be just small retracements, but overall it would have been selling. Okay, so that related to the question that if you took buys, what was the overall order flow or bias? And if you said it was bullish, well then either you read the market incorrectly or you were basing your bias on a short-term bias, maybe small retracements for like a 5-minute or a 15-minute order flow to go higher. Okay, but the higher time frame bias was bearish. Okay, another question you could potentially ask yourself when you know these kinds of things. We don't know what a PDA is yet because I haven't taught it to you, or if you do, congrats to you. But what price, was price in the correct PDA to make a sell or buy? So PDA is premium discount array. And if price is in a premium, you're looking to sell. If price is in a discount, you're looking to buy. And well, then obviously, if that makes sense, then if you're in a premium, you should be looking to sell, not buy. And if you're in a discount, you should be looking to buy, not sell. So what is price in? The pink area I've got here, well, that's a premium zone. So you look to sell. There we go. Bias, bearish, discount, premium array. So should be looking to sell. And then price sold. Okay, so very simple things like that you ask yourself. I'm not going to read through all these because it's going to take a long time, but you should definitely maybe take note of these, copy and paste them, add it to your journal. These are things that you need to ask yourself potentially later on. Obviously, maybe you don't know all of what's being at play here. So like, for example, probably don't know, is price looking to target internal or external range liquidity? Now, maybe someone here knows the answer to that question for a trade they recently took, or maybe they don't know what internal or external range liquidity is. And that does not matter because I will teach it to you anyway. But that's kind of a question that you would ask yourself. So like, for example, one of the other guys I trade with in our chat over here, yesterday they took a trade, I think over here, which was basically this turtle soup above this high, and over here it sold and price went down and their target was down here. So this was internal range liquidity and that is external range liquidity. So they traded price from internal to external. Okay, so I'm not going to teach in-depth analysis right now of what that is, but that is the goal. Price was in an internal range liquidity and my target was external range liquidity. So is price looking to target internal or external range liquidity next? So the answer to that question would have been external range liquidity next. And you don't know what I just said, well, doesn't matter, you'll learn it later. Okay, but these are just questions. These are ideas to put into your own journal. Okay, where did I add to the position and why? And if I did not add, why not? Why did I not add more positions to the sell? Okay, where and why did I exit? So yesterday we said that if we are taking this trade here, we should take profits here because this is not only external range liquidity, but it is sell side liquidity. So at sell side liquidity, we get turtle soup reversals. And if we did not take the trade, well, we would have probably either hit break even if we didn't move to stop loss to break even, or worse, hit our stop loss based on this reversal over here. So that's, a rule set basically. I'm not going to go into more detail here, guys. It's really up to each one of us here individually to come and have the time to read through this information, ask me questions. As much as I'm trying to spoon feed all of you, the goal here is to self-elevate yourself with what I'm going to teach you. This is a very basic teaching for today. And there's lots for yourself to do. You should spend at least 4 hours or so, if more, great, a week on trading, learning, educating yourself. Okay, so there's also here a book we can read, and a lot of what I'm going to teach you is either based on strategy or based on risk, entry, concept. So really a lot of chart work, and I can't really help you personally with your emotional and psychological problems. Okay, the best thing I can do for you is guide you to someone who can, And that is this book, and that is called the Daily Trading Coach, 101 Lessons for Becoming Your Own Psychologist. So let me just open this quickly over here, and I'll just give you a brief overview. So this is a very nice book for someone who does not like to read, because the book is not meant to be read from cover to cover, although you can. It's really as sort of a handbook. So you can come to this book and choose a topic that may be associated to yourself. So like chapter 1 has got all of these topics: how to build self-confidence, 5 best practices for effecting and sustaining change, or maybe whatever heading would appeal to you, you'll then come to the page number. What to do when fear takes over. So maybe some of these headings or chapters resonate with you, with your problems you are going through psychologically or emotionally, and that is a handbook guide to psychology. It's a must read, not the whole thing or the whole thing if you want to, but definitely if you want to up your game in trading, risk management, psychology, and your whole aspect of what it is that you are doing in terms of journaling. Okay, so guys, that's it for today. I don't want to bore you too much longer. I've got covered what I needed to get covered, and that would be all for now.